Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The older you get, the more you realize clarity is expensive and confusion is free. Progress is not about moving fast. It's about realizing you've been running in circles. The modern workplace has perfected a rare skill, turning simple tasks into collaborative journeys. We say we value efficiency, yet admire those who look perpetually busy. Capital flows where it is welcomed and leaves where it is needed.
Every few months, markets throw a mini tantrum. 5%, 10%, sometimes more, and suddenly everyone becomes a full-time doomsday analyst. But here's the punchline. Since the 2009 bottom, the S&P 500 is up over 1,200%, including dividends, despite 32 corrections along the way. That's not instability, that's the admission price. Investors don't lose money in corrections, they lose money trying to outsmart them. Selling fear, buying regret, classic cycle. Corrections aren't signals to exit, they're reminders that volatility is a cost of compounding. As Peter Lynch put it, far more money has been lost preparing for corrections than in the corrections themselves. Zoom out and a clear pattern emerges. Central banks are cutting almost everywhere, but inflation isn't exactly waving a white flag. Across economies, from United States to India to Brazil, real rates are still positive, in some cases sharply so. Translation policy is technically tight, but getting less tight by the meeting. Here's the tension. Inflation in many regions is either sticky or ticking back up, while rate cuts keep coming. That's not easing into comfort, that's easing into uncertainty. No speeches, no headlines, just a balance sheet quietly shifting. China has cut United States Treasury holdings by $640 billion over a decade, while more than doubling gold reserves. That's not diversification, that's a message. Less exposure to dollar assets, more allocation to something that doesn't rely on anyone's policy credibility. Call it hedging, call it strategy, either way is deliberate. And the ratio tells a story, from 10 cents to 57 cents of gold per dollar of treasuries. This isn't a sudden move, it's a slow pivot away from financial dependency towards hard assets. No announcements, no drama, just positioning. This is not a real estate trend, it's corporate behavior. It's a corporate behavior shift. India's flex workspace market is exploding, driven by GCCs and large enterprises chasing agility over ownership. Bangalore and Hyderabad aren't just growing, they're becoming global back office command centers. Demand is outrunning supply, penetration is rising, and flex is moving from startup jugaad to core portfolio strategy. Translation companies don't want long leases, they want optionality. And landlords, they're quietly becoming service providers. Not just phones, India is quietly turning into a serious PC export hub. Laptop and PC exports have surged 18x in 5 years, clocking 100% plus annual growth. And that's not a trend, that's a supply chain reallocation in real time. Global manufacturers aren't just diversifying away from China, they're actively building new bases. And India is moving up the value chain from assembly to scale. The key shift, electronics exports are no longer a side story, they are becoming core to India's trade engine. If this momentum sustains, it's not just export growth, it's industrial transformation. This is not just cricket, it's a branding arms race. RCB tops the chart at $269 million, but the real headline, almost every team is compounding like a growth stock. From Bombay Indians to Chennai Super Kings, valuations are rising, but the outliers like Punjab Kings plus 39% show where momentum and maybe hope is the strongest. So what's driving this? Media rights, sponsorships, and one key shift. IPL teams are no longer sports clubs, they're content platforms with loyal user bases.